Policy announcements by the South African Reserve Bank and the improving economic climate offshore were taken as encouraging signs for many local investors, as the Association for Savings and Investments South Africa recently reported local investors moved a net 120 billion rand into collective investment schemes last year, most of which came in the second half of the year. Joining us from Cape Town to discuss this topic, Leon Camphor, CEO of ASISA. Well, Leon, you must be very happy with the flows you saw coming through in the second half of last year. What, in your opinion, was behind that aggressive momentum?
Yeah, we're very happy, and particularly for our members. It's a very good flow into the industry. It's very difficult to find one specific reason for the flows, but I think a contributory reason was the continued cut in the repo rate, and then the latest one, which I think triggered the inflows. Just post the repo rate, 60-odd billion in the third quarter of last year and another 40-odd billion in the last quarter of the year.
Leon, just to put that into context, obviously in the third quarter last year, which was ending September, 63.2 billion rands worth of funds came into the collective investment schemes after just 16 billion in the first half of the year. Besides, the rate cut and the improving economic climate, do you think, judging from what you'd mentioned also in your press release, that intermediaries are responsible for most of these flows, the investment managers and financial advisors were telling clients to take the opportunity now to get into the equity market ahead of the surge?
I think that's a big factor. As you would have seen from the press release, a lot of the inflows are coming via the advisor market. And I think if you see where most of the funds went, about 76 billion into what is now going to be called the multi-asset class sector, I think what's happening over there is clients and advisors are saying, we don't want to choose on asset allocation. Let the fund manager or the house that we've chosen decide on that. And that multi-asset class now has become very popular, and it's now the biggest part of the assets in the industry.
Just to clarify, and just to update, I think, viewers as well, we've got two things. Obviously, you announced those results for the flows into the different categories, but at the same time, at the end of the last year, you've reclassified many of the equity and multi-asset class classifications that existed prior to that to bring yourselves up with international standards. Do you want to just give our viewers an update on the rationale for doing that and how that's actually translated into changes in putting funds of the same category together?
Yeah, I mean, within ASISA, we followed a process where ultimately our investment board committee, which is comprised of the investment managers that are members, made the final call on the classification. And it was felt necessary to update it because it had been like this for a very long time and it needed refreshing. So fundamentally, the approach was, where is the asset held and in what is the asset held? So we've got domestic becomes South African, worldwide remains worldwide, foreign becomes global, and that's not to create confusion with the foreign collective schemes that are registered in South Africa with the FSB to market here, where people can use their allowance to remit money offshore. And then we've created a category called regional at the broad category level. The what principle, we've got equity, what used to be called asset allocation, which we believe is more a process, is now called multi-asset, interest bearing and real estate.
I think a lot of people out there, Leon, want to know the strongest houses in this environment in terms of the fund managers that you've just alluded to. So who are the top players when it comes to money being allocated on this front?
Look, I mean, we've released the statistics and it's interesting. I mean, the top 10 have kind of remained static for quite a while, and between them they constitute plus minus 80% of the market. And that's Mutual, Sanlam, Allan Gray, Coronation, Investec Asset Management, ABSA, Net Group Investments, etc. If you strip out the money market funds, then it's quite interesting to see which are the bigger mancos. And I think in order, I think it's Allan Gray, then Investec Asset Management, then Coronation. And it's also interesting to see, if you talk about the funds, which just goes back to my previous point. I think Alan Gray Balanced Fund is one of the biggest, which just proves that a lot of money is actually flowing into what we now call multi-asset class funds, where the investor is happy for the fund manager to make the asset allocation decision.
That's quite an important point, Leon, and speaking to some fund managers last year, they indicated that one of the reasons why it seems that IFAs particularly are favoring multi-asset class funds is because of some of the regulatory risk and compliance risk that they may face with having some of their decisions, I guess, second-guessed by investors. Is that something you subscribe to, in terms of it's easier just to put the asset allocation in the hands of the investment manager rather than yourself as the IFA, or do you think there's other reasons why these multi-asset class funds are taking the lion's share of the inflows?
I think it's mainly the first point. I think, quite rightly so, the investor and the advisor are doing just that. Let the asset manager or the investment manager make those allocations quite clearly. You know, after the shocks of 2008, etc., I think that's prudent. The second point, which mustn't be forgotten, is that especially the smaller retirement funds, a lot of money is now flowing into that category. And about, I think, 18% of the inflow into mutual funds or in unit trust is now from that industry. And obviously they would go into the multi-asset class and the ones that conform to the prudential guidelines.
So just in terms of that, so I mean, if it's something that we subscribe to, are investors not being served? It's almost one of those unintended consequences. As the regulatory risk rises, IFAs become more conservative and perhaps not investing their clients' funds into the equity market when it's deemed necessary. They're holding back a little bit and being conservative. So do you think there's any way we can counterbalance that and make it such that the IFA can make, you know, the best interests of investors at heart?
Look, I think I can't comment and speak on behalf of the IFAs, but I think if you know your client, you've done what you call the risk analysis, your client's appetite, I believe the good IFA would still be able to say to the client, depending on the client's life stage, how they're positioned and their own psyche, you know what, for you at this stage, probably you should have greater exposure to equity, and so maybe you should pick a general equity fund and then have the balance in an asset allocation fund. And we're not for 1 minute saying you shouldn't have money in the money market, where historically a lot of money flowed into the money market. What we are saying is understand why you've got the money in the money market. That's money you might need for whatever reason. It's not your long-term investable money. And when you go, whether you choose equity with your IFA or balanced, multi-asset, you must take a long view, because that's the whole essence of savings.
Leon, just further to Warren's comment, have we got a stable IFA environment at the moment after the shake-up that we've seen over the last couple of years? Do you think that the worst is behind us, we're now on a firm footing, so to speak?
Look, I mean, once again I stress, I can't speak on behalf of the IFAs, but they are a very important distribution channel for all the ASISA members. I mean, I think there was a lot of angst in the market with all the regulatory exams that had to be written. There's more to come, and I think that will continue, but there are very good quality IFAs out there who shouldn't have a problem writing the exams. I think it's just an effort to further professionalize the industry. And what's also been very nice is that the regulator has realized, and in the conjunction with the ASISA, that certain cohorts of products and certain cohorts of advisors selling very specific, very standard products, that the regulatory exams are probably not appropriate for them. So they've allowed a carve out an exemption for that sector as we speak. In due course they will probably still have to write the exam, but an exam appropriate for what they do, what they sell, and the target market they service.
Leon, just to come back to the number of funds that we have in the market, we have 967 funds registered in South Africa as collective investment schemes. I know the FSB is quite keen on certainly restricting the growth in funds. I just wanted to get your take on the sort of split there between funds that were run by South African investment managers and the funds that were being registered in the country from foreign asset managers, either wanting to set up a domestic fund or set up a feeder fund to a global or offshore fund.
Okay, if we split the two out, the 970 odd or what local funds, you know, we can debate whether it's too many. There's a view that probably in the context of our market there are too many. There are other views that say you should foster competition. If you compare it globally there's about 76,000 funds to choose from. In terms of the foreign collectives that are registered here by the FSB that can market their funds in South Africa to local South African investors, and just bear in mind that's the money you're allowed to ship offshore that goes in there. They're currently about 319, it's declined somewhat, but it does give the investor quite a bit of choice, but if you're not well advised could probably also create some confusion.
And just in terms of the total assets, you say that about 1.2 trillion of South African rand is invested in collective investment schemes. What's the split between
Yes.
what's invested in South Africa and offshore? And are South African investors, have they got enough offshore exposure at this point?
There's about 1.2 trillion locally, and I think there's about, I forget the number, but about 14 billion that's 43 billion, that's 143 billion that's invested offshore.
So that's X the 1.2 trillion. So we've less than about 10%.
Yeah, that's X the 1.2 trillion, and that's genuine offshore. You must remember you can invest in rand-denominated funds that have offshore exposure. That's in our local unit trust industry, but it then means you have foreign or global exposure in your investments, but if you're in cash, you get your money back in rands. So they're two distinct parts of the market.